which AI stocks could be the biggest winners and which ones could be potential losers. In this video, we'll get an expert opinion on that, and we'll explain how all these companies fit into the AI economy. So let's get started. This is Ticker Take.
John, we've talked a lot about AI stocks, but we've never explained the entire AI economy in one video.
That's true, Caroline. And if you want to make smart decisions as an investor, especially with a group of stocks that have run so far, so fast, it helps to know the bigger picture.
Absolutely. And to do that, we're joined by Dan Rohinton. Dan's a portfolio manager at IA Global Asset Management, and he has spent a lot of time thinking about this. So let's hear from Dan now.
Dan, thanks so much for joining us. Nice to have you back with us on Ticker Take.
Good to see you.
If you're investing in AI, it helps to understand everything, like the value chain. Can you briefly explain that to us?
So it is such a complicated and thorough process, but let me simplify it into a few big blocks for you. The first one is the actual base materials itself, the copper, the electrical wire, the generation. Then you got to go further up. It's the chips itself. It's about the foundries. It's about the Nvidias of the world, the designing of those chips, and the companies that go and do the heavy lifting there. From there, you go into the data center. Within the data center, you have the big hyperscaler companies, the Googles, the Amazons, the Meta platforms, the Oracles, the Nebulouses of the world. You can bring all those into the conversation. Then you go to the large language model companies, which is your Anthropics, which is cloud, which is your ChatGPTs, your Google Geminis, and then you go further up to the software layer on top of that, and the distribution platforms that really share that information. And there's a data sublayer within that, which I think we should get into in the future. And then from the very top of the house is actually the end consumer itself. That can be the enterprise, or that can be you asking, well, does this steak look a little bit expired, or can I still eat it or not? And that is that full value chain. And where you get the value differs over time because the bottlenecks change and the expectations change when you're looking at the stock market today.
All right. Well, you just built the AI house for us. So that's very helpful context. And we are going to get into a number of stocks. You referenced a couple of them there. Before we do that, what's the most important thing for investors to consider in all of this?
Where we are in the cycle. Because I think it's important to really stratify this conversation and say, and this isn't my words, this is NVIDIA's head of distributed systems saying, are we going to change the world with this, or is this going to be a free app on the 99-cent store? So the real question that's being raised here is, are the hundreds of billions of dollars that are being spent wisely, or are they going to be commoditized away in short order? In the same way that we think of all the apps that are free on the App Store and say, that's great, but was it worth $10 billion for the company that actually built it? So the commoditization risk over time is the question on whether this is going to change the world or if this is the dark fiber moment 2.0.
All right, Dan's going to walk us through some key stock winners and potential losers. But first, this is not financial advice. Stock group number one. The hyperscalers.
Well, you alluded a little bit to this group earlier, but Amazon, Microsoft, and Google's parent Alphabet are the three that you really wanted to highlight. You know, it feels to me like these are the companies that can scale AI around the world. Cisco helped to build the internet back in the day. These companies are helping to build out the AI economy, but they've got so much more to their businesses as well. How important are they for investors?
They're critically important, and for two reasons. They're the enablers and the distribution points for the technology, especially in the enterprise level. And let's be honest, they're also the big backstoppers that are making the large language model companies even able to invest the tens, let alone the hundreds of billions of dollars into the data centers today. So when you talk about ChatGPT and OpenAI, its parent company, spending money on data centers, that's Oracle doing that. And that's Amazon doing that. And that's Google doing that. And then there's Microsoft doing that. So the permutations change, but the hyperscalers are critical as a distribution endpoint and also the capital backers for the large language models. And then the question really comes down to is, are they going to be deriving the primary value over time? Because they have, in the past two technology cycles in software, really gotten a lot of the value and earned some pretty solid margins.
Okay, so at the end of the day, if you're an investor trying to make decisions around where your money is best spent, that's different for everybody.
Yeah.
But Amazon was one name in particular that you like now. How come?
The reason for that it's basically a tactical decision because Amazon as its whole, you're more familiar with it as the average investor and the average person walking down the street as the company that ships the cardboard box with the stuff that I want in it.
Right.
But fundamental to what they do and the more profitable part of their business is Amazon Web Services, which is the most successful and the incumbent hyperscaler. And what's the question mark on Amazon is that they were too slow on this AI inflection, and they've been playing catch up with building out a lot of capacity. And what tends to happen is when capacity gets built out, the revenue starts showing up in short order because the market is so tight on chips right now that if you bring on a 1 million GPU cluster, which is an Nvidia chip, that revenue starts coming through the door basically right away. So the real bet on Amazon as we look through the upcoming quarters is, are we going to see a re-acceleration the same way we saw for Google Cloud and the same way that we saw for Microsoft Azure?
Okay, so at the end of the day, all the companies in this group are juggernauts.
Yes.
So is there a potential loser in this group?
Yes, and potentially all of them. And that's why I say the future is unknown right now, but I would say we're still in the part of the cycle where there's still an acceleration going on. Where we look at on the other side of this cycle a few years from now potentially is, did OpenAI did Microsoft create by accident a giant competitor to its own business? Did Anthropic outcompete Amazon on the same software verticals that Amazon offers? Because when you're a large language model company and everyone starts their journey with OpenAI and ChatGPT, maybe Amazon becomes the back-end balance sheet. Maybe GCP does. And maybe Microsoft Azure does. So the big debate, I'm going a little bit in too many tangents here. Let's narrow this conversation down. If you're Microsoft and if you're ChatGPT, you're going after that same enterprise customer. ChatGPT is the starting point of the journey for hundreds of millions of people now. Maybe you start there instead of doing a contract with Microsoft. Did Microsoft open the kimono to its own future competition? I don't think so. And I think there's chances that this all fits into a bigger pie over time. But that is a question you can't help but ask yourself for all of these hyperscalers.
Stock group number 2, the semis.
Okay, well, these are the hardware players that are powering the AI revolution. The names that you wanted to highlight, they've come up a lot on Ticker Take. Nvidia, AMD, Broadcom, Taiwan Semi. Same question as before. Can you afford not to be looking at this group if you're investing in AI?
It's too important because there's two things that are necessary for AI. Electrons, which is power, and chips, which is Nvidia, if you want the leading edge merchant solution. And if you want custom, because you have more special needs, Avago Technologies, or Broadcom as it's also known, and AMD, which is also trying to compete in that type of vector as well. And then the big unsung hero in this whole conversation is Taiwan Semiconductor, which does all the heavy lifting for all these companies.
So does that mean, like, when it comes to top picks, Taiwan Semi and Nvidia are two names that continue to stand out for you? Is that correct?
Yes. And I would say in that ranking, if you force me to choose between one and the other, I'd say Taiwan Semi first and Nvidia second. And the reason I say that is Taiwan Semi is the pinch point for everybody. So Nvidia basically goes to Taiwan Semi and says, I want my chips for 2027 and I need this percentage capacity. Taiwan Semi can say, well, that's great, but we're sold out because AMD wants them too. The price is 20% higher. That type of dynamic, when push comes to shove, and when you really want to boil it down on who has the power, Taiwan Semi has the ultimate final power and the final say because they do the hardest work.
Now, I want to ask this question about, is there a loser as well? And a reminder to people that historically, this is a cyclical industry as well. That's more of a bigger picture factor. But are there potential losers within this group?
I think what's interesting about this is right now, it doesn't seem so because everyone's sold out for years. But the question you have to ask yourself is what you alluded to a little bit earlier, is hardware as important over time? Because hardware tends to get commoditized. And the only company, and it's spoiled us because it's been so successful, that has managed to create a true moat in hardware has been Apple. Every other hardware company in history has basically turned into the Seagates of the world, the EMCs. These are all ancient names at this point. Dell had its time, IBM had its day. The only company that lasted persistently has been Apple. So the question really is, does hardware have a structural moat? Over time, as the hardware demands slow and supply and demand balance itself out a little bit, I'd say chances are it's not, which is why I say probably other parts of the value chain make sense. But for right now, this is the gold rush.
Stock group number 3, the data pipes.
Well, Dan, I guess AI can only be as powerful as the data that it is feasting on. So that gets us into a group we haven't talked with our audience a lot about, information and analytics companies. So that would include companies like Relx, that you wanted to highlight, S&P Global, FactSet, and London Stock Exchange. Again, how important is this group?
So it's interesting. They basically are two facets that are needed in the whole value chain. One is the actual data itself, and they're the cleanest source of financial data. And they're also the distribution point. So if you're Claude for finance, which is the Anthropic large language model, you need LSEG's data. Relx data would be fantastic. And FactSet has some proprietary data as well. And you need a distribution footprint already, because for the consumer, it's just our phones. If it's for someone in finance and in investment management or wealth management, chances are it's one of the terminals that are offered by FactSet, Thomson Icon, which is owned by LSEG Group, S&P Global with Cap IQ. So that type of yin and yang is critically important as we move further down the journey away from the hardware gold rush towards the distribution and the cleaning up of data and getting more defined outcomes out of the large language models.
So is there a top pick in this group of companies?
I think the best position is the London Stock Exchange Group. And I think Relx is a dark horse for me as well, but for a different type of sub-industry. And the reason I think the London Stock Exchange Group is the perfect way to fit on this conversation is they've got the widest reach for distribution. So if you're talking to your local financial advisor, chances are they probably are a customer through the workplace platform. And chances are if you're using Microsoft Teams, that's all going to be integrated with the London Stock Exchange. So distribution scale on one end, John. The other end is this is the company that's got satellites up in the sky to make sure they're feeding the data at the exact time that the companies need it. And you really have to map it out with very low latency. So it's one thing to say data is data, but it's another thing to have high quality, institutional grade, scaled global data. And if you're trying to build AIs for all around the world, I can't help but see how they don't have a role to play.
Yeah, you want good stuff and you want it fast.
Exactly.
Is there a potential loser in this group?
I think FactSet of the bunch, even though I think it's generally a well-managed company and has been pretty disruptive in the past 20 years for the data industry, the problem they run into is they're a little bit too front-end and they're not enough back-end. They're too much distribution to advisors and not enough of the data pipes. So I think they really have to pivot their business model and invest a lot of dollars to really get that working and humming in a way that the other companies simply don't need to.
And our final group, the private companies.
Okay, this is where things get very interesting because when we talk about AI stocks, oftentimes we're referencing OpenAI, which you talked about, or Anthropic, which you talked about, or even Elon Musk's XAI. But none of these companies are public or investable today. But could that change?
I think if we're going to see the first ever $1 trillion IPO, it's probably going to be one of these companies because these companies are already worth $500 billion in the private markets. And that's also because they are some of the fastest growing software companies that we've ever seen. So these viral sensations across the consumer and the enterprise have just meant they've come into life so quickly that normally the process has been grinded out, have a decade or so of really building out, refining the product, and then you see the revenue and then you go public. Here, it just feels like the time has inverted in the other direction, where the product and the revenue showed up basically right away with the advent of GPT-3 and onwards, that we might have to wait till they're $1 trillion before they go public.
And would you want to invest in those companies with those $1 trillion valuations? How do you feel about investing in these companies if you had the chance to do that?
Today, I don't think their multiples are actually outrageous. And I think the reason for that, because as a dividend manager, the first impulse is always to say, well, all this stuff is overpriced and expensive, and I like this cereal maker company instead. I don't think that's true. I think we need to keep an open mind. What we are seeing is the Uber and Lyft and Didi playbook happening in terms of their customer acquisition. So what I'm trying to say is the fact that they're losing money is not a problem because their unit margins are strong. So OpenAI, let's use that as a simple example because it's the biggest, most prominent one. They charge users anywhere from $0, which means the advertising is going to come, to $25 to $30, or up to $400 if you really want to go pro tier. So that's a full price ladder. Then you have hundreds of millions of users, and that's growing at a pretty fast rate. And so you're seeing strong revenues. You're not seeing the profits yet because they're basically underpricing their product and they're trying to get enough critical scale. And by critical scale, I mean getting basically the whole world to adopt it. And then the real profit flush happens in the same way you saw for big tech in the early days, and then also for the Ubers and the Lyfts of the world, which is why I say when I see the growth rate, when I see the revenue estimates that have been rumored and that have leaked out of these companies, and I see their valuations, I see a company that's worth $500 billion.
All right.
We'll see in a few years how that looks. But as of right now, it's not ludicrous to say OpenAI is a $500 billion company because the fundamentals would justify it today along with the growth rates for the next few years.
Dan, good to see you. Thanks for the time.
Pleasure.
All right, our thanks to Dan Rohinton for giving us his take on AI stocks. You can learn more about Dan in our description.
Where we've also got a link to our free investing newsletter. And please make sure to subscribe so you don't miss our next investing video. And if you're listening to us on the podcast and you like what you hear, please give us a rating.
Absolutely. Thanks so much for watching. See you next time. Or will we? Oh, Lola,